So I just want to have a quick look at a few ratios and how to analyze the ratios. In other words, how to comment on the ratios. So we have here the return on shareholders' equity. We have the prior year's figure and then the current year. Then we have the earnings per share, the dividends per share, net asset value, and the market price, together with the debt equity ratio, the number of shares in issue, interest on loans, and then your return on total capital employed. So I decided not to go with a past paper. I decided to just list a few of these ratios, and then I have prepared a few questions that will hopefully help you when you have to then do a past paper in preparation for your exams. So it's a bit of a different approach because otherwise we get used to the questions in the question papers and we don't really know what it is that we are doing. We just do it because that's what the memo said. Sounds familiar, right? Okay, so here we have question number 1.1. How can the return on shareholders' equity be used to analyze the profitability of a company? So that's a new way of asking it because usually it's just comment on the return on shareholders' equity. Now the question is, how can we use this to analyze our profitability? And that means that we need to first understand what the return on shareholders' equity is. So I have the slides that I had for the video where I actually discussed each one of these ratios in a bit more detail. So we said that return on shareholders' equity measures the profitability from the shareholders' perspective. This question is now asking, how is that possible? How does that happen? And in order to be able to comment on the how, it means that first of all, you need to understand what is within this ratio. It says that net profit after tax divided by the average shareholders' equity times 100% will give me my ROSHE. So in other words, I'm taking my net profit after tax and I'm dividing that by the average shareholders' equity. And then we said that the higher, the better, must just be at least above the interest rates that banks will offer. So now the question is again, how can we use this to analyze the profitability of the company? The way that we use it is we are going to see how much returns, so how much profits we are generating using our shareholders' equity. So in other words, the capital provided by the shareholders alone, are we able to use that capital to generate profits? Okay, so that is how it helps us. So, or how we use it is we are going to see if we are generating profits using that return, that capital. So the question number 1.2 then is, please now analyze the return on shareholders' equity of this company. So now you can use that. Now that you know, it means that can I generate profits using the capital that the shareholders have given to this company? Can I do that? Is there profit being made? And the question, the answer to that is that we are generating profits. We are generating profits of 12% per annum using our shareholders' equity. And now, if we look at last year we had 16%. And remember when I spoke to you guys about the analysis and interpretation, I said that you must always compare it to the prior financial year, the industry norm if available, and then also to your interest on loans. So your first step would be to say that the return on shareholders' equity decreased from 16% in 2024 to 12% in 2025. So that is you now saying what the trend was. What happened? It decreased from 16% to 12%. And then you are going to say that this means that we are generating less profits. in 2025. Okay, so we have been able to generate less profits, less returns, because returns is then your profit. So we've been able to generate less returns in the current financial year. And we can see that by looking at ROSHE, that is now 12% and no longer 16%. This is also above the interest rates offered by the banks. So this is lower than the 14% interest offered by banks. Okay, so remember we said that in that previous video where we discussed the ratios a bit more in detail, we said that shareholders can take their money and they can put that into a fixed deposit at a bank and they can earn interest. Now they're saying that the interest is more or less 14%. So the shareholders could have taken their money to the bank and they could have earned interest at 14% per annum. Yet they decided to invest in your business. Now your business is only giving them returns of 12%. So the shareholders will not be satisfied. So the shareholders will not be satisfied because this is below the 14% interest they could have earned risk-free, remember, risk-free, by depositing their money in a fixed deposit. Okay, so that would have meant that the money stays in the bank account and it just earns interest at 14%. You don't have to worry about any reputational damage that's going to result in your money suddenly being less, worth less. It's not going to be a situation of the company might shut down. Now you're not going to get your dividends. None of that, because you will get your money from the bank. So yes, if we have to say how we can use ROSHE to then analyze profitability, we are going to say that we're looking at the profits that we are generating when using the shareholders' equity alone. So are we earning a good return as shareholders? And then we are going to compare that to the prior year to see, did it improve or not? In this case, unfortunately, it didn't. So the shareholders will also be a bit concerned, because if this is just a one-year thing, like something happened within the industry which resulted in lower profits, then obviously we will still be okay. However, if we have this return that's now going to be on the decline moving forward, then we will not be satisfied, because obviously we want our investment to grow. We don't want the return to be lower and lower every year, because then we're just going to opt out. We are going to try and find another investment before the share price plummets completely. Okay, so that is your ROSHE. Then, how can we use earnings per share to analyze the profitability? Okay, so first we use the return on shareholders' equity. Now we are going to use the earnings per share. And what is earnings per share? It's exactly in the name of that ratio. Earnings per share. Earnings, profits. Remember I said when I said return on shareholders' equity, I also said we're referring to profits here. So earnings per share, how much profit did the company make, but now per share. So when we looked at our return on shareholders' equity, we said it's the profits over the average shareholders' equity, the amount. Now we're looking at the per share. So now it's the number of shares. And we are going to do that by taking the net profit after tax divided by the number of shares in issue times by 100 to get the cents value. So in other words, if we're looking at our earnings per share, we are looking at how much profit is the company making per share issued. Okay, that's it. How much profit is the company making per share issued? And here with this one, earnings per share last year was 120 cents per share. This year it is 85 cents per share. So there's a decline. And that means that we have been able to generate less profits. And we can see it with the ROSHE as well. So we haven't been able to generate the same profits that we did in the previous financial year. And this might be because management haven't been able to now manage our expenses effectively. Then usually with this question comes your dividend payout ratio, because remember, now you're saying this is the profits that are made per share. So per shareholder, I now want to give you something because I need to say, thank you for giving me your capital to be able to operate this business. So you need to get dividends. But I can't now give you all of the earnings in dividends because I still need to retain some of the profits to be able to expand the business or just to operate the business moving forward. So dividend payout ratio is taking your dividends per share divided by your earnings per share. And in this case, it was 34 divided by 85 times by 100, because this is given in a percentage format. So in other words, you're calculating the percentage of your earnings that, oh gosh, not multiply, the percentage of your earnings that you now distributed to your shareholders. So 40%. 40% is the percentage of earnings per share that you distributed to your shareholders. Comment on this. So the commentary is a lot, it's basically open-ended to a certain extent. I don't want you to say that the company should be paying higher dividends, because think about it, if they pay more dividends, they are retaining less of their profits less of their profits, less of their returns to be able to generate a profit in the next financial year. So we can't say that we must just keep our shareholders satisfied. We must consider the future of this company. Because remember, if we're thinking about responsible management, about corporate governance, directors need to always act in the best interest of the company, because the company has employees, the company has shareholders. All of those people need to be considered when we are making these decisions. So in this case, I would have said, I would have been satisfied as a shareholder if this was the payout ratio. The reason being that the earnings per share decreased since last year. So I can't expect a high dividend payout if my earnings per share are already on the decline. So we need to be realistic as well. If the profits are on the decline, then you can't expect high dividends. Looking from the director's perspective, because remember, you don't know what we're going to ask. Are we going to ask you, should the shareholders be satisfied? Or are we going to ask you, why did the directors do this? Do you agree with their decision? Then, if it's a case where your earnings and your returns have decreased since the prior financial year, you will be satisfied if the directors don't pay half or more of their earnings per share out in dividends. The reason being that the directors were acting responsible here. They wanted to say thank you to their shareholders by giving them a dividend of 40%, but they were also realistic. They also saw that, listen here, if we now pay out 60% of the dividends, how are we going to fix what went wrong here? So the directors were definitely responsible in their decision to not pay out higher dividends. They didn't give us the previous financial year's dividends. We don't know what the industry norm is. So that is as far as our commentary can go. Next up, did the debt equity ratio improve since 2024? Once again, we're looking at the trends here. So did it improve or not? Last year, the debt equity was 0.4 to 1. This year, 0.7 to 1. Therefore, the debt equity increased. That's your first commentary. This means that because there was an increase, it means that no, it did not improve, because it means that In 2024, we had 40 cents in non-current liabilities for every 1 rand in equity. This year, we have 70 cents in liabilities for every 1 rand in equity. So clearly, we are relying a bit more on third-party loans this year than what we did last year. Okay, and then a reason for this, I just gave that reason when I said that it's possible that we are relying more on our third-party loans. It could also be that there was a lot of buyback of shares, because that would have resulted in you having less ordinary share capital. And remember, if you maybe made use of your retained earnings because you bought the shares back at a price that was a lot higher than the average share price, then that would have had to affect that your ordinary shareholders' equity decreased even further. So it could have been that as well. So either a decrease in ordinary share capital, retained income due to high dividends or buyback of shares, or it could have been that you obtained new loans. Is the company credit worthy? So yes, the company is credit worthy because they are below 1-to-1, their debt equity ratio. So yes, they are credit worthy. However, they have now moved from being a low risk, below 0.5-to-1, to being a moderate risk, moving towards a high risk. Okay, so we want that ratio to be maximum 1-to-1, but 0.5-to-1 would be ideal. So no, it's not like a complete extreme high risk yet. It is now moving from moderate towards a high risk, but we are still credit worthy. And then comment on the company's use of loans. So clearly this year we are a bit more reliant on third-party loans than last year. And then also please include ROTCE when it comes to reliance on loans. Because remember, if we go back to that other video, with ROTCE, we said, okay, you might be relying heavily on loans, but it might be that you're really generating good profits using those loans. And if we're looking at ROTCE, it's saying that last year, using my capital and my equity, I was able to generate returns of 18%. However, this year, when I now increased my loan, I was able to also increase my return on total capital employed. So clearly, I have been able to use this loan to generate better profits. So yes, my debt equity ratio is a bit higher, but I can make good use of the money to then generate returns on my capital. Also, we said that we want to make use of loans if our ROTCE is higher than the interest rate. And clearly it's a lot higher. So last year it was 5% higher. This year it is 8% higher than the interest on loans, even though the interest on loans increase from the one year to the next. So we are definitely making a profit here. It's good for us to have these loans because we can make profits using the loans. We are positively geared. We are also negatively geared still. It's only once it reaches 1-to-1 when we will say that we are highly geared, even though we are actually moderately geared. But for some odd reason, you'll see that in the grade 12 notes, they only comment on lowly geared and highly geared. They don't really address the moderately geared that much. And then I've also seen different sources with different answers with regards to when is something lowly geared, when is it highly geared. So that's why I prefer working on a ratio of 0.5-to-1. Is after that, you're really going to be very concerned about your business because then they are not credit worthy. Okay. Right. Then the last one is comment on your company's net asset value. Once again, what is net asset value? It is the value at which I am basically now carrying this share within the business. So it indicates stability within the business. It indicates how much the share is worth by looking at my financial statements. At nothing else, only my financial statements. And we said that we're going to take the total equity divided by the number of shares in issue to find this, and then we are going to compare it to our market price, or then the last issued price if we don't have the market price. Here we have NAV of 620 cents and a market price of 950 cents. So we will say that the shareholders should be extremely satisfied because the market is willing to pay 950 cents for a share that by books, according to the books, is only worth 620 cents. So if I now want to sell my shares, I might actually make a profit just by selling my shares, never mind the dividends and stuff that I earned whilst I had these shares. So this is good. It means that the company, even though there's a decline in the returns, they are still considered a good investment. They still have a good reputation. But you must also look on the Debbie Downer side of this, because remember, the people think you are doing well. They regard you as a good company because of the image that you put out there. So the question would just be, why are people valuing your company at 950 cents per share when it's only 620 cents? Are you perhaps being deceitful? Are you trying to fool people, trying to trick them into buying shares by selling this wonderful dream? Or is it just that you are a startup company? Maybe you only started trading in 2024 and now you are still building on whatever the operations is that you have been doing, building on that process, improving that process, and people out there can see this. Therefore, they actually do believe that hopefully sometime soon your returns will increase by a lot, and that's why they feel your shares should be valued at 950 cents each. And that was it. I hope this helped you guys.